Hello, everybody. Good day. Today is January 22nd, and this is Mastermind number 68. Welcome to those of you who are joining us, wherever it is that you're joining us from. And let's get things underway. So, continuing in our series, we are continuing with Rich Dad, Poor Dad. How exactly did this meeting come about? Why exactly are we here, actually? And I will bring that up. And yeah, we're doing things a bit of the traditional way that we're used to these days. So, Mastermind number 68, January 22nd, 2024. Now, why exactly are we here? How exactly did this come about? Today on the agenda, we have Overcoming Obstacles on Rich Dad Poor Dad, Chapter 7, a bit of real estate education, news and market updates. Today, we're going to be going over what exactly are interest rates, understanding it, the types, as well as the news, top stories in Canadian real estate right now. We're also going to be going over cryptocurrency education, news, as well as market updates. And as you can see, in accordance with the letter I, we're going over what exactly is an institutional investor. News with regards to the Bitcoin ETFs overtaking silver ETFs at the moment. And as a disclaimer, the content here is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing discussed constitutes a solicitation, recommendation, endorsement, or offer to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which solicitation or offer would be unlawful under securities laws of such jurisdiction. I'm not a licensed financial advisor, definitely not a CPA, and not a lawyer. Please consult a licensed professional before making any decision. There are risks associated with investing in securities, investing in stocks, bonds, exchange traded funds, mutual funds, and money market funds involves risk of loss. This meeting was inspired by this book that's called Think and Grow Rich and written by Napoleon Hill a long time ago, but still one of those top books that a lot of people who are very successful that they relate to in terms of what exactly the concepts of it teaches. So as you can see here, let me just put this, oops, wrong. Okay, yeah, there we go. So if you go in there and you look at this page, you'll see you who read this book will get the most out of it actually by putting into practice the mastermind principle described in this book. This you can do as others are doing so successfully by forming a study club consisting of any desired number of people who are friendly and harmonious. The club should have a meeting at regular periods as often as once each week. The procedure should consist of reading one chapter of the book at each meeting, after which the contents of the chapter should be freely discussed by all members. Each member should take notes, putting down all ideas of their own inspired by the discussion. Each member should carefully read and analyze each chapter several days prior to its open reading and joint discussion in the club. Reading the club should be done by someone who reads well, understands how to put color and feeling into the lines. By following this plan, every reader will get from its pages not only the sum total of the best knowledge organized from the experiences of hundreds of successful people, but more importantly, by far, you will actually tap new sources of knowledge in your own mind, as well as acquire knowledge of priceless value from every other person present. So um, that's exactly how these meetings ended up starting to really happen. And the first part of this is going to be more of a webinar style with regards to Rich Dad, Poor Dad. And then we're going to jump into our networking aspect slash real estate and cryptocurrency, as well as private equity market updates. So we had stopped last on page, or a bit further than this. We're on page 129, I believe it is. Yeah. So overcoming obstacles. So we just finished the chapter on working to learn, not working for money. So chapter 7 in Rich Dad Poor Dad starts out overcoming obstacles. The primary difference between a rich person and a poor person is how they manage fear. Once people have studied and become financially literate, they may still face roadblocks to becoming financially independent. There are five main reasons why financially literate people may still not develop abundant asset columns that could produce a large cash flow. The five reasons are: number one, fear. Number two, cynicism. Number three, Laziness. Number 4, bad habits. Number 5, arrogance. Overcoming fear. I've never met anyone who really likes losing money. And in all my years, I've never met a rich person who has never lost money. But I've met a lot of people who have never lost a dime. Investing, that is. The fear of losing money is real. Everyone has it, even the rich. But it's not having fear that is the problem. It's how you handle fear. It's how you handle losing. It's how you handle failure that makes a difference in one's life. The primary difference between a rich person and a poor person is how they manage that fear. It's okay to be fearful. It's okay to be a coward when it comes to money. You can still be rich. We're all heroes at something and cowards at something else. My friend's wife is an emergency room nurse. When she sees blood, she flies into action. When I mention investing, she runs away. When I see blood, I don't run. I pass out. My rich dad understood phobias about money. Some people are terrified of snakes. And for those of you, the fear of snakes is called ophidiophobia. Learned that from my spelling bee days. Some people are terrified about losing money. Both are phobias. He would say, so his solution to the phobia of losing money was this little rhyme. If you hate risk and worry, start early. If you start young, it's easier to be rich. I won't go into it here, but there's a staggering difference between a person who starts investing at age 20 versus age 30. The purchase of Manhattan Island is said to be one of the greatest bargains of all time. New York was purchased for $24 in trinkets and beads. Yet, if that $24 had been invested at 8% annually, that $24 would have been worth more than 28 trillion by 1995. Manhattan could be repurchased with money left over to buy much of Los Angeles. But what if you don't have much time left or would like to retire early? How do you handle the fear of losing money? My poor dad did nothing. He simply avoided the issue, refusing to discuss the subject. My rich dad, on the other hand, recommended that I think like a Texan. I like Texas and Texans, he used to say. In Texas, everything is bigger. When Texans win, they win big. And when they lose, it's spectacular. They like losing? I asked. That's not what I'm saying. Nobody likes losing. Show me a happy loser, and I'll show you a loser, said Rich Dad. It's a Texan's attitude toward risk, reward, and failure I'm talking about. It's how they handle life. They live it big, not like most of the people around here. Living like roaches when it comes to money, terrified that someone will shine a light on them, and whimpering when the grocery clerk shortchanges them a quarter. Rich Dad went on. What I like is the Texas attitude. They're proud when they win and they brag when they lose. Texans have a saying, if you're going to go broke, go big. You don't want to admit you went broke over a duplex. He constantly told Mike and me that the greatest reason for lack of financial success was because most people played it too safe. People are so afraid of losing that they lose, were his words. Fran Tarkenton, a one-time great NFL quarterback, says it's still another way. Winning means being unafraid to lose. In my own life, I've noticed that winning usually follows losing. Before I finally learned to ride a bike, I first fell down many times. I've never met a golfer who has never lost a golf ball. I've never met people who have fallen in love who have never had their heart broken. And I've never met someone rich who has never lost money. So for people, the reason they don't win financially is because the pain of losing money is far greater than the joy of being rich. Another saying in Texas is, everyone wants to go to heaven, but no one wants to die. Most people dream of being rich, but are terrified of losing money, so they never get to heaven. Rich Dad used to tell Mike and me stories about his trips to Texas. If you really want to learn the attitude of how to handle risk, losing, and failure, go to San Antonio and visit the Alamo. The Alamo is a great story of brave people who chose to fight, knowing there was no hope of success. They chose to die instead of surrendering. It's an inspiring story worthy of study. Nonetheless, it's still a tragic military defeat. They got their butts kicked. So how do Texans handle failure? They still shout, remember the Alamo. Mike and I heard this story a lot. He always told us this story when he was about to go into a big deal and he was nervous. After he had done all his due diligence and it was time to put up or shut up, he told us this story. Every time he was afraid of making a mistake or losing money, he told us this story. It gave him strength, for it reminded him that he could always turn a financial loss into a financial win. Rich Dad knew the failure would only make him stronger and smarter. It's not that he wanted to lose, he just knew who he was and how he would take a loss. He would take a loss and make it a win. That's what made him a winner and others losers. I gave him the courage to cross the line when others backed out. It gave him the courage to cross the line when others backed out. That's why I like Texans so much. He would say they took a great failure and turned it into inspiration, as well a tourist destination that makes them millions. But probably his words that mean the most to me today are these: Texans don't bury their failures, they get inspired by them. They take their failures and turn them into rallying cries. Failure inspires Texans to become winners. But that formula is not just the formula for Texans, it's the formula for all winners. I remember the second time that I went to Texas, actually, I was looking at everything. I was like, why is this gas station so big? And then they started telling me all this history about Texas and this and that. And they're saying, so from what it is that he's talking about here, I can really see it. You know, the way it is that they speak, how they handle different situations and more. Um, it's really different from other places. I've been to other parts in the US and it's not exactly like that. So, well, in that way specifically, I can see in terms of what it is that he's saying with everything really being bigger. I remember falling off only made me more determined to learn to ride, not less. I also said that I have never met a golfer who has never lost a ball. For top professional golfers, losing a ball or a tournament provides the inspiration to be better, to practice harder, to study more. That's what makes them better. For winners, losing inspires them. For losers, losing defeats them. I like to quote John D. Rockefeller, who said, I always try to turn every disaster into an opportunity. And being Japanese American, I can say this. Many people say that Pearl Harbor was an American mistake. I say it was a Japanese mistake. From the movie Tora Tora Tora, a somber Japanese admiral, I've never watched that movie actually. A somber Japanese admiral says to his cheering subordinates, I'm afraid we have awakened a sleeping giant. I remember Pearl Harbor became a rallying cry. It turned one of America's greatest losses into the reason to win. This great defeat gave America strength, and America soon emerged as a world power. Failure inspires winners, and failure defeats losers. It's the biggest secret of winners. It's the secret that losers do not know. The greatest secret of winners is that failure inspires winning. Thus, they're not afraid of losing. Repeating Frank Tarkenton's quote, winning means being unafraid to lose. People like Fran Tarkenton are not afraid of losing because they know who they are. They hate losing, so they know that losing will only inspire them to become better. There is a big difference between hating losing and being afraid to lose. There is a big difference between hating losing and being afraid to lose. Most people are so afraid of losing money that they lose. They go broke over a duplex. Financially, they play life too safe and too small. They buy big houses and big cars, but not big investments. The main reason that over 90% of the American public struggles financially is because they play not to lose. They don't play to win. They go to their financial planners or accountants or stockbrokers and buy a balanced portfolio. Most have lots of cash in CDs, low yield bonds, mutual funds that can be traded within a mutual fund family, and a few individual stocks. It's a safe and sensible portfolio, but it is not a winning portfolio. It's a portfolio of someone else, of someone playing not to lose. Don't get me wrong, it's probably a better portfolio than more than 70% of the population has, and that's frightening. It's a great portfolio for someone who loves safety, but playing it safe and balance on your investment portfolio is not the way successful investors play the game. If you have little money and you want to be rich, you must first be focused, not balanced. If you look at any successful person, at the start, they were not balanced. Balanced people go nowhere. They stay in one spot. To make progress, you must first go unbalanced. Just look at how you make progress walking. Thomas Edison was not balanced. He was focused. Bill Gates was not balanced. He was focused. Donald Trump is focused. George Soros is focused. George Patton did not take his tanks wide. He focused them and blew through the weak spots in the German line. The French went wide with the Maginot Line, and you know what happened to them. If you have any desire to be rich, you must first focus. Do not do what poor and middle class people do. Put their few eggs in many baskets. Put a lot of your eggs in a few baskets and focus. Follow one course until successful. And I will actually pause there. So, roughly 5 pages, but a jam-packed 5 pages. And the chapter again is titled Overcoming Obstacles. The primary difference between a rich person and a poor person is how they manage fear. And so he starts off by talking about the 5 reasons as to why it is that many people never become financially independent. And it's because of fear. You fear something, cynicism, you're a cynic towards certain things. You have the attitude of laziness. You have certain bad habits that you fail to get out of or that you fail to replace with better habits. Or you're just arrogant. Nobody can talk to you. You already know everything. You don't have a willingness to learn and a willingness to change. And so he talks about exactly overcoming that fear. People work hard for their money. If it is that you're working a job or maybe you're leveraging debt or whatever it may be, you work pretty hard in terms of getting there. And so many people will have a fear of losing money. Most people, honestly. But the fear of losing money is real. Everybody really has it, even the rich people. But it's not having the fear that is the problem. It's how you handle that fear and it's how you handle this losing. And that's really where he starts to talk about in terms of overcoming those obstacles. So on your way to achieving whatever it is that you may, whether it's being rich, whether it is that it's this or that, or whatever it is that it may be, you're gonna have some obstacles, and it's how you handle them that really matters. So honestly, it's basically he's saying that it's guaranteed that you're going to fail and you're going to have those obstacles, and it's pretty normal, but it's how you handle it that really matters, and how you're handling that defeat, overcoming that fear. It's okay really to be fearful. Um, it's okay to be a coward to money, but you can still have what it is that you want. So that was the main theme in terms of the chapter, and he uses different stories in terms of going about that, talking about somebody who starts investing at age 20 versus age 30 and vice versa. Some people, they'll ask, where do you think is the best place to invest? Or, what do you think is the ideal age to start investing right now? Because tomorrow is a new day, and that's 24 hours later, according to, the clocks that we use in terms of keeping time. So he gave a certain example of Manhattan Island in terms of one of the greatest bargains of all time. And uh, making that similar to a quote that one of my mentors always used to say, scared money makes no money. Scared money makes no money. If you'd like to retire early, it's not going to come by playing it safe. It's going to come by playing risks, by having a certain kind of risk appetite and taking a certain level of risk with certain things. And that's really the cost of getting what exactly it is that you want. If you want time freedom, if that's something that one wants, if you want locational freedom, if you've always wanted to travel somewhere, all those deep desires of your heart that you may be tucked away because they were maybe confined by maybe your situation or maybe what it is that you imagine that things, are like no, or what you think that they could have never been. Well, go back to dreaming. Like an 8-year-old child. Somebody asked, what do you want to do for your birthday? I want to go to Disneyland. Well, the kid isn't thinking about there's no money to go to Disneyland. You just ask them a question. What do you want for your birthday? You didn't ask them based on budget, blah, blah, blah. They don't understand anything about all of that. Don't lose that child inside of you that is able to just dream. It's still there, and to have all the things it is that you want. It's still there. Just that you maybe not so, you're maybe probably not so open-minded in terms of what it really takes to get there. And so your dreams end up dying because of that. Be like the Texans. Go big, Go after what exactly it is that you want. And you might lose, And like the Texans say, if you're gonna go broke, go big. And many people, that's happened to them. I was talking with somebody today, very successful individual, and they were telling me, hey, yeah, I've made 7 figures and I've also lost 7 figures and I've been bankrupt. But guess what? Guys still out there playing the game, still playing the game, not in playing the game in a bad way. It's more of saying, and he's doing pretty well, I should tell you, by the way. But it's not the first time I've heard that, and most people it is that I've spoken with, who are financially successful in a certain way or whatever it is that it may be, went after something it is that they really wanted. They had their own failures before, and so it's key in terms of overcoming those obstacles, how we handle them, and that's what really really matters. So for those of you who may be listening, go after that thing it is that you want, overcome that obstacle. Do not let the fear overtake you. Handle it in the right kind of way. Failure inspires winners, and failure defeats losers. So I'll pause there for now, and that concludes what we're gonna go for in terms of and if you look at the names, it is that are mentioned here. John D. Rockefeller, as mentioned, and in the last part he was talking about Thomas Edison, Bill Gates, Donald Trump, George Soros, George Patton, and the other examples were all situations in where it is that people were focused, not balanced. Um, and what are they really talking about in terms of balance? But it's balance in terms of, you have to do this way, you have to do that way, you need to have this before it is that you have that. But what about you need to be focused? Follow one course until successful. Uh, Personally, when I was going through a period in my own time when it is that I was spending a lot of time by myself, and I was determined that I was going to achieve something, and that was a financial goal at the time. I did end up achieving that financial goal, but I can tell you along the way, I felt so lonely because life was imbalanced at that time, honestly. And people were saying, "Oh, why you're focused on getting the money and this and that and whatnot." And I was just saying, look, like, who's gonna do it? Are you gonna do it? No, I need to do it. So pardon me if this is happening or that's happening, but you have to kind of follow one course until successful. Now, whether it is that you believe that or not, different people have different beliefs. Not everybody is really a fan of Robert Kiyosaki, but the concepts of life, a lot of them it is that he uses, and we can all learn something from what exactly it is that he goes over here in terms of having a certain kind of focus. Obviously, you want to have some balance in your life, and money is not everything. There are other aspects of life that really determine your wealth and more, and so that's really the key thing in terms of looking at. So we will continue with the next page, 135 in the next section. And I'm just going to briefly go over um, one or two things here that we had prepared. So from a real estate standpoint, numbers came out with regards to inflation with Canadian real estate. Canadian inflation accelerates, moderate recession has kicked off. And let me just pull this up here. And I did something last week, and I'm going to do it again. And it's just a matter of looking at what exactly is in the news. Last week we saw where it is that we were looking at um, unemployment being increased, rumors of interest rates staying higher for longer, and yeah, this is it. So here's the article, and I'll go back over the week in review kind of. So I'm using Better Dwelling as the news resource site. Canadian inflation accelerates, moderate recession has kicked off. Now, obviously, you realize that this is not good. It's not good in terms of from an economic standpoint. So Canadian headline inflation is heading in the wrong direction. Stats Canada CPI shows annual growth at 3.4% in December, up 3.4 points compared to a month before. The rate is higher than anticipated, but attributed to the base effect of a few components. At least one prominent economist believes Canada is already in recession. And I feel like they have changed what exactly they define as a recession. In the past, it has been, what is it, 2 or 3 quarters of negative GDP, but that definition has really changed in recent years from what it is that I've been researching. So Canadian inflation accelerated largely due to gasoline base effect. StatCan largely attributes the acceleration to a base year effect with gasoline. A base year effect is when the original period in a comparison experienced an abrupt distortion. Annual growth of gasoline prices were 1.1% in December, a big change from decline of 7.7% reported in November. In this case, it was due almost entirely to the shift in prices from November to December 2022. The rigid 12-month comparison masked the monthly decline of 4.4% in December. Now, all of this is going to come together. Shelter costs also continue to push inflation higher, rents in particular. CPI estimates annual growth of 7.7% in December, adding 0.3 basis points in November's rate. So I'm not going to go over all of it for the rest of it, but you can see the overarching theme here. Bank of Canada's preferred inflation measure continues to slow. Bank of Canada's preferred measure also set aside inflation concerns. Core CPI showed 3.4% annual growth in December, 0.1 points lower than November. This measure excludes the two most volatile components, naturally, energy and food, which tend to be influenced by global production. By excluding these measures, central banks can better focus on the role of local currency driving inflation. So here's the opinion of an economist that believes that Canada is actually already in a recession. Falling inflation is typically a sign of reduced demand, helping to ease supply concerns. This is typical ahead of a recession, and the Bank of Canada has warned they expect a mild one. At least one prominent economist felt they're underestimating the outlook, especially against the backdrop of today's CPI data. Unlike the Bank of Canada, which still anticipates a soft landing, we believe the economy has slipped into a moderate recession, explained Tony, it's either Stillo or Stillo. I think it's Stillo, Director of Canadian Economics at Oxford Economics. His less than rosy perspective continues, in our view, growing slack from the deepening downturn, alongside an easing of global oil and world food prices, which will help return headline CPI inflation to the Bank of Canada's 2% target by late 2024. So now we're above 3%. The target that we have for inflation in Canada is 2%. And so based on what he's saying, this changing different things should help to get that back to 2% by late 2024. So Bank of Canada has maintained a hawkish tone, implying they're ready to raise rates if needed be. Again, however, Stillo's outlook doesn't include much potential for higher rates in this environment. This means further rate hikes by the Bank of Canada are not warranted, and we expect it will keep the policy rate steady at 5% until June, when it will begin to gradually ease to 4.25% by year end. Expectations of easing rates have already led to lower financing costs, boosting demand. However, Oxford Economics rate forecast is in line with the most forecast estimates. At that level, financing costs might be lower than today, but would be considered lofty in contrast to the decade-plus low rates driving the Canadian debt binge. That has experts skeptical of any substantial near-term growth. So you look at this, in terms of from a rate standpoint, and you look at what else is going on. Canada's real estate bubble is compare crazy compared to other G7s. So if you look at this article, you'll realize their argument or thesis for saying that the Canadian real estate market is actually in a bubble in comparison to other G7s. And they go in depth as to, well, not in depth in this article, but if you read a bit more into it, as to why exactly they do believe that it's in a bubble. Canadian real estate markets improved, but prices are still falling according to BMO. So markets slightly improve around December year end, but prices overall, they're still falling. So you realize that there's a theme here. One economist is saying that um, we're in a moderate recession. Um, you look at it, says that we're in a housing bubble. You look at it, it's saying that markets improve slightly over on a month-to-month basis, but prices overall are still falling according to BMO. So you're seeing rumors of recession, saying that we're in a bubble, prices falling, Bank of Canada to hold rates, but push back on cuts next week, according to RBC. So rumors that rates are going to be held. Canadian mortgage rates may resume climb as bond yields surge. And you know that bond yields and mortgage rates are related in a very, very, very close way. Canadian inflation accelerates. So we're seeing rising inflation, rumors that rates are going to be up. That's two things you're seeing. Rising unemployment, you're seeing that prices are falling, and all of this is not good news. It's not good news for the economy per se, and it's not just rumors. It's, it's things based on substantive evidence with regards to what exactly is going on. And so it's not just people talking, it's actually backed by numbers, and really the numbers don't lie. You go to another news source like Bloomberg or Financial Post and you're seeing similar things. So what exactly is this saying, for example, for investors? Even I was doing some numbers on some properties earlier, and it makes it a bit more difficult to find good deals, rather, even create good deals rather. It implies that we have to be a bit more flexible in terms of our strategies that we're using in terms of approaching properties. One of my mentors slash business partners is, saying that, okay, maybe in terms of, for example, doing a bear, it's going to be a bit more difficult in terms of doing that because rates are so high is one thing, not just that one, but if inflation is also so high, and maybe it's like, a 1% off from the target 1+%. If inflation is increasing, then chances are whatever you're paying now, um, you're going to be paying more next year. So when we're doing our numbers, apart from putting in, income and expenses, your dollar is losing value in terms of how much you're able to purchase, and not just that, whatever you're paying in terms of an expense, there's an unseen tax there that is in inflation. And for the most part, people don't typically account for that. And so those are things it is that we consider from an investment standpoint. Your debt servicing is a lot more up now in terms of properties. People are about to renew their mortgages, or maybe doing the numbers and realizing that this asset is not going to be cash flowing if it is that you renew at this rate. People are saying, do we take the variable? Do we take the fixed? That's a subjective thing in terms of, people making their own independent decision. But that's a whole other thing. So, be tighter on doing your numbers, be, way more conservative, and be flexible with the strategies. While it is that, just like Kiyosaki spoke about a while ago, in terms of fear, scared money still makes no money in the market. This creates opportunity. Many people will be afraid. Many people are afraid. There are less offers going in on properties. But what? People are still acquiring. People are still utilizing a lot more creative financing, vendor takebacks, seller financing. If you are not so familiar with those terms, it's probably a good time to learn exactly what those are. as many people are looking at that now. So creative financing is one. Being tighter in terms of doing one's numbers is another thing. And when we look at it, look for good deals as to how exactly you can create those win-win situations for sellers and people as well in your power team. So um, I'll stop there for now, and I'll actually go over to what's going on in this market that's at the opposite end of the spectrum that with cryptocurrency. So a lot of inflows in the market within the past 7 days or so after the news in terms of the Bitcoin ETF. And we can see, let's look at this from a macro standpoint in terms of how this asset has performed. This was January 2012. It was at 5 cents, and now it's at 40.8 thousand, so 40,800. This article was really key, and I'm saying it's key because it really went into well, just from in terms of from what exactly it is, you're looking at the biggest markets on the planet, and you're looking at the certain commodities. You talk about gold, you talk about silver, and you talk about Bitcoin overtaking Bitcoin ETF overtaking what exactly is this silver ETF. So Bitcoin is certainly topped silver in ETF market and trails only gold among commodities. So I was fascinated by this market, spent a bit of time getting educated in it. Many people were afraid and still are actually afraid of what exactly this is. And granted, that's normal. It's not exactly a physical asset. You can't touch it like you touch silver. You can't touch it like you touch a physical business or a property. But the newly launched Bitcoin exchange traded funds already have nearly 30 billion in assets under management. Silver ETFs only have 11 billion. So not only did it overtake silver, it more than doubled the amount in terms of assets under management that silver has. And silver has existed since dying stars started spewing the metal out billions of years ago. Bitcoin is 15, but it's already a bigger deal in the US ETF market. Bitcoin ETFs had more assets than silver ETFs the instant the SEC approved them last week and trailed only gold among commodity-focused US ETFs. So without reading the rest of it, the long and short of it is that the amount of money that's flown into Bitcoin ETFs is now more than silver and trails only gold in terms of commodity focused US ETFs. So why is that important? That's really a big milestone because not many commodities have really done that. And when you talk about how long gold has been around, how long silver has been around, and that's a big reason why it is that many people will classify an asset like this as digital gold per se. So I'm gonna pause there for now. And that's it for today as the mastermind number 68. I'm gonna stop the live, and that's that. If you'd like to join the Zoom, send me a message and my assistant will send you the Zoom link so you can access. But apart from that, thanks for joining in today, everybody. And let me stop this thing. See you next week.